All right. Well, hello, everyone, and welcome to the Microstructure Exchange. This is our last seminar of the spring/summer season. And we're very excited to have Christian Westheide. Christian, did I do a good job this time with the last name?
Yeah.
Okay. Talking to us about colocation. Christian asked that we hold our questions until he stops at the usual 15-minute and 30-minute marks. But of course, there's also a chat that you guys could put your questions in. And before I hand it over to Christian, just a quick reminder that there is a call for papers that we have posted on the webpage. It closes on July 1st. And we look forward to receiving your new papers for the fall series of the Microstructure Exchange. Christian, thank you so much for being here, and please take it away.
Thank you, Andri. So this is a paper, it's joint work with Satchit, Sagade and Stefan Scharnowski, and we have a double disclosure there that it's neither reflecting the views of ESMA, where we got our data from, nor those of Nasdaq, where Satchit is now working. So he was still in academia when we started this project. And so most of you will probably be familiar with research on colocation as used by the very fastest market participants. And so we're going to look at whether actually more ordinary brokers also benefit from colocation, and whether they benefit from colocation when they trade for their institutional customers and for their own account. No. No. Okay, this is not good. I just have to change my sharing because let's try this one. So many brokers nowadays claim that they are able to use technology in a way that eliminates or at least substantially reduces any disadvantages that they may have compared to the fastest participants. So this is quoting here a report where actually the title is "We are all high-frequency traders now" by Credit Suisse. And they argue that they are able to use HFT strategies and tools and offer them to their clients so that they use the same sophisticated technology and logic. And so that suggests at least they want to make customers believe that they are able to compete with the fastest traders and that their customers benefit from that. On the other hand, we have here a quote from Jeffrey Bassidor, who claims that many brokers actually use algorithms that don't necessarily benefit from fast connections because they use what's called a timer-based processing rather than event-based processing, meaning they look only occasionally at the market. They wake up, check whether a decision needs to be made on changing an order or submitting an order, and then they fall asleep again for some time before they return to look at the market. And so the question then for us is whether those brokers who should have the capability of benefiting from fast connections because they do subscribe to colocation facilities offered by exchanges, whether they benefit when trading for themselves and when trading for their customers. And so we are focused on institutionally sized trades. So we're not trying to capture any profitability of market making strategies. So we're looking at directional trading and whether these trades appear to minimize transaction costs. So you have two questions then. Do any benefits that may arise from colocation differ between proprietary and agency trading, and do costs generally differ between proprietary and agency trading? And if they do, what can explain the differences that we do observe? So of course, there's a lot of literature on institutional execution costs, and there's earlier literature that studies various determinants of execution costs. So from this literature, we basically take the standard predictors of execution costs, like things measuring how difficult a trade is to execute, characteristics of trading strategy, investment style, trade direction, choice of trading value. And then there's another literature that looks at aspects that may help explain differences in execution outcomes. So some of them may be more on the agency problem side, others maybe just differences in skill. So Anna et al. Measure differences in broker skill, and they conjecture that this may be related to how sophisticated brokers are in using technology, though they can't directly observe that. And so we asked the question whether technology, as proxied by using colocation, whether that explains differences in execution outcomes, not only across brokers, but also within a broker when trading for the own account or for customers. So before jumping into our analysis and the data, just a brief overview of how we view the economics of institutional trade execution. So the sell-side investment banks provide these services to the institutional investors, and it can be quite difficult for institutional investors, especially those that are not the very largest, to get a precise evaluation of the quality of the services that they receive. So they do need highly granular data, and they need large amounts of data because the variation in execution cost of individual parent trades is quite large. So you need a large data set to be able to precisely measure any differences in quality that might be actually there. Of course, they need technological skills, and they also do need the incentives to actually fully understand the execution quality, which may not be 100% there because they don't necessarily directly benefit from lower execution costs. And the sell side has, of course, the incentive to optimally use all resources when trading on their own account. Though if they are costs associated with providing algorithms, for example, because colocation facilities have a limited capacity, they may save costs, and they may choose to save costs by offering algorithms that don't make full use of the technology that's available. Other issues are that some buy-side participants may not be able to choose the best execution algorithm. So even if the offered algorithm menu were to allow to achieve very low execution costs similar to those that the proprietary trades incur, it doesn't necessarily mean that all buy-side participants are able to do so. And one other aspect is that some of the very largest buy-side firms use their own algorithms. So presumably they do use sophisticated algorithms. So any disadvantages that customers might have compared to proprietary trades shouldn't exist to the extent that large buy-side firms use their own algorithms. So what's our data set? So we use data from ESMA that comprises 83 stocks in various European markets, 1 month of data, and we are able to track the participants, the exchange members across multiple markets. So for each stock, we have the 4 most important markets. And so we can track participants across stocks, across venues, via masked exchange member IDs. And additionally, we have some members flagged as high-frequency traders. So this is based on the primary business model. So this flag comes from ESMA. And furthermore, which is important for our analysis, is that we know which members are co-located on which exchanges. So this is available for all primary exchanges, and for Terpras, it doesn't exist for BETS and the Chi-X. The flag doesn't exist, but this is what we use as our co-location dummy. And then for the distinction into agency and proprietary trading, we also have this trader capacity associated with each order in the market. Then we need to take the data and aggregate it into institutional trades. And so we mostly follow their Korajcik and Murphy by taking within one exchange member a sequence of uninterrupted trades in the same direction. And of course, these orders, these trades have to be the same capacity. So we stitch together sequences of agency trades, and we stitch together sequences of proprietary trades. We have a minimum parent order size, and in addition, we apply a filter by Putnitz and Barbara that each parent order needs to take at least 2 hours. Then we drop the very smallest exchange members, so we require those in our data set to have at least 10 parent orders executed and arrive at a data set of more than 11,000 parent orders by 139 exchange members. And so some of these exchange members trade only on their own account, others trade only for customers. And then we have 36 members that trade in both capacities. And our main measure as a dependent variable in the analysis will then be execution costs measured as the average price paid minus the arrival price, which is the price before the first Chi trade, and then signed by the sign of the order, so buy or sell order. Our data set comprises stocks from small caps of a few hundred million euros in size to the largest European firms. And most of the trading volume for the less liquid stocks happens on the primary exchanges. So PM stands for the primary exchange, but all of them have some degree of fragmentation. And in terms of liquidity, so there's no stock that is extremely illiquid. So spreads range from, on average, 30 basis points for the small caps to an average 9 basis points for the large caps. We have statistics on our exchange members. So this is taking one observation per exchange member. Most members trade on only a subset of the countries in our data. And the distribution is quite skewed. So we have some very large members, but many smaller ones. And only about a third of participants trade on venues away from the main exchange. So this is important to understand for those not familiar with the European market, that it's not required to connect to the competing venues. So it's allowed for the brokers to trade only on the main exchange, even if these MTFs, the competing venues, possibly offer better prices and sometimes. On average, the participants trade a bit more than half of their parent orders in an agency capacity. And about 30% of the members have any colo, meaning they are co-located on at least one venue, and conditional on being co-located somewhere, they on average co-located on about 2 venues. So if there are any questions, I can take them now.
I think Pete just posted
Yeah.
a question. Pete, would you like to go?
Yeah, I just asked a question. It sounded like, based on what you said, that the parent orders are kind of hypothetical constructs from orders that you see arriving in the same direction. And what do you do then about the opportunity cost of cancel parent orders that were only partially executed because they were underwater and you never see the order sent to exchange? So I sent an order I start out with an order for 10,000 shares. I execute 7,000, the market's running away from me. I cancel the remaining 3,000. Those 3,000 never submit orders to the exchange. They're not part of the sequence that you see. And yet there's a huge opportunity cost associated with marking them to the initial price. So it seems like there's a huge bias here, or potentially huge bias, unless you're quite confident that the parent order, the true parent orders are fully executed.
Yeah, I do understand the problem. I think it's there in basically all the papers on institutional execution costs, unless the authors have a direct link to the institution itself. So yeah, we cannot consider opportunity costs. We can only measure observables, and I think that's in common with the most of the remaining literature on this topic.
Any more questions, folks? Please raise your hand and go ahead. While we wait, Christian, a quick clarification question. Are all the brokerages in the data set co-located, or are there the ones that are not?
No, only about 30% of members are co-located anywhere, and they are all not. So nobody is connected everywhere. So we have differences between brokers and differences within brokers.
Okay. And do you know if this service, the colocation plus the algorithms, are they bundled? In other words, do you get an algorithm that is already collocated so you don't have to make a decision on collocation separately? Or is that a separate decision?
When you say you're referring to the buy side, or?
As an institutional client of a brokerage buying an algorithm from them?
I believe you're getting offered a menu of algorithms, and I kind of doubt that you get them flagged as including Codo or not. But even if you do have Codo, I mean, the question is how you use it. So if you use these timer-based algorithms, I mean, maybe they are labeled as using collocation, but they're not making effective use of it.
Mm-hmm. Okay. Okay, I think we don't have any more questions, so we could proceed.
So then let's take a look at the statistics on our parent orders. So about half of our parent orders are executed by a broker with collocation. So that means the larger brokers, of course, are more likely to have collocation, and that's why this is more than the 30% of brokers who have any collocation. Yeah, about half of the parent orders are agency orders. We have some differences between proprietary and agency orders. So at least some of the differences are statistically significant. In terms of trade size and whether they are buy or sell orders, there's no significant differences between the categories of proprietary versus agency orders. Typical orders take about 5 hours. Of course, there's a large dispersion there as well. And maybe something that's noteworthy is that on average, these orders that we have in our data set are not very aggressive. So a minority of child order executions is actually liquidity consuming. So that's the case for both proprietary and agency orders, though it's to a larger extent for proprietary orders than for agency orders. Child order executions, about 70 per parent order, but of course also a wide distribution. Yeah, a bit more than a quarter of executions happen on the MTFs. though again, there's some dispersion between the two categories. Then we have a summary of execution costs. And so because so many of these orders are relatively passive, we obtain average execution costs that are actually negative. So negative compared to the arrival midpoint price. This is one reason for the negative average. Another reason for the negative average, which I'm not showing you on the slide, but on average, these trades in our data are uninformed in the sense that if you look at the price a couple of days later, it hasn't moved in the direction of the parent order. We measure child order execution costs as well, so half spreads and price impacts, though in the later analysis, we're not using them because if we have time, we can discuss this later. They're not very informative for the parent order costs because the supposed quality of an execution of a child order doesn't necessarily translate to being a beneficial part of a parent order, dependent on how prices move before or after a child order execution. About 31% of all orders are traded against frequency traders, and about 2/3 is against liquidity consuming frequency traders. So the interaction with HFT isn't our main topic, but we'll also take a look at which part of variation the HFT might explain. So our main analysis then uses execution cost as a dependent variable. And so what will be controlled for? Well, several measures of the trade characteristics, which we'll see in the regression table. Then we have dummies for agency capacity, for colocation. We have interactions between them. We have proportion traded against HFT. And again, this interacted with being colocated and various fixed effects. So we have stock day fixed effects. We also have fixed effects for the time of day when a parent order starts. And in part of our analysis, we also look at a variation within exchange members. So we're using exchange member fixed effects. And yeah, in the table, you'll see we have some regressions that use subsets of these regressors and then others, the full specification. And so, as you saw already from the descriptive statistics, there are some significant differences between agency and proprietary trades. And we could look at this more closely and also see that there are differences between being collocated and not being collocated. And so we're using regression adjustment combined with weighting. So we estimate the probability of a trade belonging to the 4 categories defined by the 2 capacities and being collocated or not being collocated. And so we use this doubly robust estimator, which controls for these predictors, but also weights the observations accordingly to protect ourselves from a misspecification of one of the features of our regression. But all our results also hold if we don't use any weighting of our observations. So these are our baseline results before looking at any collocation and capacities. So all of these regressors are motivated by the previous literature on institutional execution costs. So unsurprisingly, it's more expensive if your payment order is large. It's more expensive if you trade more aggressively. So aggressiveness is a measure of how much of your order is traded via liquidity consuming child orders. And then we have some predictors that may not cause large prediction costs, but help explain them correlationally. So having many child orders is associated with larger execution costs. Trading more on the MTFs is also associated with higher execution costs. It's unlikely to be causal. It's more likely the case that if it's more difficult to trade, then you spread your orders across more venues. One important predictor here in the regression that's the largest statistically is information, which is the measure I alluded to earlier, which is the return from the start of the trade to the closing price the day after the pivot order concludes. Next, we look at our main variables of interest. The first model, we just, in addition to all these predictors that we had on the previous slide, we just add a dummy for agency orders. And so we see on average an agency order after controlling for everything that is observable is about 4.5 basis points more expensive than a proprietary pivot order. If we add colocation, well, if we don't distinguish between colocation for customer versus for proprietary orders, we don't see much of an effect. But if we use colocation in Model 3 plus the interaction of colocation and the agency capacity, so that means the colo dummy now measures the benefit for proprietary orders that these orders gain from colocation. We see that there's a benefit of about 6 basis points for proprietary orders. But for agency orders, this is fully offset. So there doesn't appear to be a benefit for agency parent orders from having a broker that uses colocation. Next, we take a look at whether HFT can explain any of the variation in execution costs. So we see the total volume traded against HFT is positively associated with execution costs. And if we separate this into liquidity consuming and liquidity providing HFT orders, we see this is coming from the aggressive HFT orders, whereas there's lower execution costs associated with trading against passive HFT orders. So this is if you don't use colocation, or at least this is unconditional of having colocation. And if we interact that further with colocation, we see that most of this is offset if you do have colocation. So that means the relative benefit of trading against HFT liquidity provision are offset if you use colocation. And the interpretation is not that somehow you're losing a benefit, but that the execution costs don't differ anymore dependent on your liquidity provider. So that means you can more reliably route your liquidity consuming orders, and you don't depend on some beneficial liquidity provider happening to be there in the order book and trading against you. And on the other hand, the aggressive HFTs, their effect is also reduced, but not fully. So you're still exposed to possibly informed aggressive HFT orders to some extent, even if you have colocation. These regressions also contain triple interaction between colocation, HFT, and agency trades. So these coefficients here in column 6, they are for proprietary trades. But the remaining interactions, I mean, they're mostly in the expected sign, but not significant. Next, we look at the same thing, but we add exchange member fixed effects. So everything we're identifying here now is within an exchange member. And so in the first column, you see the agency dummy is still significant and it's substantially larger. So that means within a member, that offers both agency trading and trades on their own account, the execution cost difference is larger than in the total sample that comprises also those that are active in only one of the two capacities. If we again include colocation and the interaction with agency trading, the results are the same as without exchange member fixed effects. So there's a benefit to using colocation, but it's not there if you're an agency trader. Effects of HFT are again similar to what we observed without fixed effects, without exchange member fixed effects. And so these results are basically confirming what we saw in the specification that didn't rely on identification within exchange members. And to get an idea whether there are differences between brokers, or whether the results we find are driven by only one or a very small number of brokers, we are plotting here for those brokers that offer both proprietary and agency trades, or that trade in agency capacity and also offer agency trading, and that are co-located somewhere. We look at the differences for those co-located orders between the two capacities. And so you see most of the differences are positive. So positive here means agency trades are more expensive. And yeah, some of the most active participants also have significant differences. So you can see it's from the error bars. Of course, the very largest ones are from small participants with large error bars. But in total, it's not driven by a small number of participants. And non-parametric tests also confirm that this is a positive effect size. Yeah, I will take another break here.
So Sophie had a question. Sophie, would you like to say your question, or would you like me to read it?
You can read it.
Yeah, I can see the question. So
okay,
so
Christian, read it.
Yeah, so whether the broker or whether it's apparent whether the broker uses the colocation for a given order.
Yeah, so because it was my understanding that for the clients, you may want to use colocation services when you rebalance your portfolio, for instance. So you are not looking for speed, but execution at the same time for a sample of stocks. So I was wondering whether there was this endogeneity in the choice of using the colocation service or not.
No, we can only see whether a given participant is co-located on a given exchange. So that means we know whether in principle they have the ability to enjoy benefit from co-location, and whether they make use of that, we cannot observe. So we know brokers could use it in principle. Whether they actively choose against using it, or whether they use it in a way that doesn't benefit some of the customers, we cannot observe. So we only know they have the skills, they have the connection, and whether they use it when they trade for the customers, we cannot observe.
Any more questions, folks? I was hoping to ask a quick one. In one of the previous tables, Christian, you mentioned that when you're not co-located, you benefit from taking liquidity from HFTs. But then when you are co-located, that benefit seems to go away. And you said that's because the benefit is derived from, you derive equal benefit from all liquidity providers, no matter whether they're HFTs or not. Am I right?
Right. So basically, the differences in execution costs that are driven by HFT, if you are not co-located, they go away because all of your trades in general become less expensive if you have co-location. So this goes into the colocation dummy. So it's not the case that somehow HFT liquidity provision becomes worse for you. It's just that in total, you're smarter at submitting your market orders. And so that's why there's no difference anymore between trading against HFTs or against other limit orders that might be provided at prices similar to those orders that you would otherwise have traded against HFTs.
So, okay, so the small part of this that I'm still missing is I kind of would imagine that grabbing HFT orders, HFT limit orders is the hardest thing to do if you're a large institution, because they, of course, try to run away from you. So how is it, I'm just missing the connection. How is it that it becomes easier to interact with non-HFTs, but not with HFTs when you are co-located? Am I making sense?
So I wouldn't say it's become easier to interact with others. It's just that those interaction, or let's say in general, liquidity provided by HFTs is relatively low cost for liquidity takers. So HFTs provide relatively good limit prices. And so if you do have co-location, you can, even, of course, you don't observe who's your counterparty, but you can better submit your market orders that on average you're trading against better priced limit orders. And so that's why the difference with HFT and non-HFT liquidity provision goes away, because those other orders that you trade against are at better prices, since you have the ability to better route your orders.
Mm-hmm. Okay, Pete?
Yeah, so the costs on the vertical axis are basis points. So it looks to me like half or more to the left are costs on the order of 20 basis points. And 20 basis point cost difference strikes me as being improbably large if all you're picking up is the difference between co-location and agency trades. That difference to me should be a fraction of a tick. So you must be picking up some kind of selection bias or timing issue that differentiates these types of trades, and not a difference between co-location and a broker and agency.
If this were the cost of a child trade, I would fully agree. Of course, you wouldn't be able to earn more than a tick. But these aggregate over tens of child trades. So if every child trade is a fraction of a tick worse, and moves the price a fraction of a tick in the wrong direction, then the average execution cost of the total parent trade can be this much worse. So charge order execution quality doesn't look that much worse. That's true.
You're saying you didn't control for trade size?
We control for all variables that I showed you in the baseline. But
it's improbable to me that the price impact of one type of trade is going to be different from the price impact of another type, given that people in the market don't know whether these were broker agency trades. They're just observing the ticker. So the price impacts of these things are going to be the same.
It depends on what the state of the order book is when your child order is submitted. So all parent order characteristics are controlled for, but if the child orders are submitted in a way that's not very smart, I mean, that can move prices. So if you submit a market order against a thin order book that ticks the price to the next level, that's one example that might be not so ideal as a part of a parent order execution, and so that's a way how these cost differences can add up over several hours of trading.
So you think that'll generate 20 basis points of different costs? To me, that sounds like 2 basis points.
I mean, the average in our estimate is 8 basis points. Training is for individual participants, but of course, there's always estimation error in there. So the average in where part of this is the effect of co-location, part is generally differences between agency and proprietary orders. But on average, it's not 20 basis points, but it's still sizable.
Yeah, strikes me as improbably large. I'll leave it at that.
Christian, would you like to take more questions, or would you
Yeah,
like
sure,
to
why
come
not?
back?
So
Okay.
I'm just seeing.
So Marius asks a provocative question. If brokers are front-running their clients using colocation.
I don't know if they need colocation if they want to front-run their customers. I mean, if they provide the execution algos to their customers, then probably they don't need colocation. They have the knowledge of the parent order sitting there and can front-run whether they use colocation or not. I don't think that they do either, but I don't think that relies on colocation.
Okay, and PK, would you like to say your question, or would you like us to read it? I'm going to try to read it then.
Is it driven by order execution or fast order cancellation?
Go ahead and read if my internet is poor.
Okay, PK, we have a terrible time hearing you. Sorry about that. Okay, Christian, let's try to read the question instead of having PK say it.
Yeah, is it performance driven by order execution or fast order cancellation? And so, I mean, that's something you could measure only at a child execution level. So you couldn't infer based on avoiding one bad execution what this means for the parent order execution cost. And so for child order executions, we don't see patterns that easily translate to parent order execution costs because simple measures of spreads or short-term price impacts don't necessarily mean the same thing as if you think about an informed trader who wants to execute one large order in a single step. So I don't think you can, based on any data, that you can actually say whether parent orders execution costs are driven by child execution or child cancellation.
All right, Christian. So it looks like we have 2 minutes until we hit 11:45 here. But
yeah, let's
take.
Here.
Don't worry about it. We can take, let's say, 10 more minutes.
No problem. All right. So yeah, so what we look at next is how these different types of orders differ in behavior that we can observe in terms of order submissions and cancellations. We can't say in any clear causal interpretation that this is what drives differences, but these are apparent differences that may help explain differences in outcomes. And so first we look at the periodicity of order messages. And so the x-axis here is seconds within a minute. And so you see all kinds of participants submit more orders at the beginning of a minute. But this is more strongly the case for these agency orders, and relative to proprietary orders, this is also more the case within collocated orders for agency than collocated for non-agency. And if you look at the remaining time axis there, so you see also these 10-second spikes that are prominent there for agency collocation. And so that suggests that this pattern of using timer-based algos seems to be stronger for agency orders than for proprietary orders. We see basically the same for order cancellations. So again, the spikes for agency collocation and much less prominent for the others. And as a kind of placebo, we look at order replacements by the exchange. So these are order replacements as a result of, I think, mostly repricing packed orders, which can result from any other changes in the order book. And of course, if generally there's more activity at the beginning of a minute, you're going to see more activity at the beginning of a minute in this type of order replacement as well. But you don't see any significant differences between these four categories here, which is what you would expect, because this is just the exchange fulfilling its task of repricing an existing order. And then another analysis of the kind of individual order submission differences is that we just compute the order to trade ratios of the different categories. And so I suppose unsurprisingly, co-located participants have a higher order to trade ratio, so they revise their orders more frequently. Though that's not the case for these agency orders. And within exchange members, we also see generally fewer or lower order to trade ratios for agency orders, and also again for co-located agency orders relative to proprietary agency orders. So again, hints to this less active monitoring of the order book, which may lead to, on aggregate, worse execution outcomes. Then we look at possible explanations for these differences in execution outcomes that might stem from incentives on the side of the sell side participant. So one thing that might drive results would be exchange fees. So if we try to minimize exchange fees because maybe we cannot pass on the exchange fees to the customer, then that could possibly explain differences. But that's not what we see. So unconditionally, with respect to co-location, agency orders have larger exchange fees. And if you look at model 3, so for co-located agency orders, you need to add up agency and colo times agency and colo. And so there's no differences in exchange fees between co-located proprietary orders and co-located agency orders. So there doesn't appear to be an attempt by the sell side to minimize orders, order fees based on exchange fees. And the same we observe within exchange member. Lastly, one question or one motivation for certain order routing behavior might be that we want to limit the risk associated with the outcome. So maybe the buy-side investor is a mean variance optimizer, so they don't only want to minimize execution costs, but also variation in execution costs. So we look at, after conditioning on all the order characteristics, how do the regression residuals differ? So that you could consider those the surprise in execution outcomes. And while the coefficients there are slightly negative, the magnitude, so it's 1.5 or 2.5 basis points, that's much smaller than the average difference in execution outcomes. So no reasonable utility function would accept, let's say, 8 basis points on average worse execution outcomes if that were to allow you the residual to on average be 1.5 basis points smaller. So we think this cannot explain the differences in outcomes either. So let me wrap up. So we do find co-location can help reduce execution costs to economically significant magnitudes. We don't find that customers benefit from the broker's co-location. And we see that the order submission behavior suggests a lack of active monitoring of the market for these customer co-located orders versus the proprietary co-located orders. And we can discard some explanations that might appear obvious, but that are too small in magnitude. And so, yeah, the results raise some questions about best execution obligations. I think there's no question that anything of this would violate regulations, but economically, the question is whether it wouldn't be possible for the buy side to obtain better execution given the capabilities that the sell side possesses. And with that, I'd like to conclude.
Thank you very much, Christian. Any questions, folks? A quick question about one of the charts you showed before. So there were some algorithms that seemed to be following a time clock.
Mm-hmm.
And when you were talking about it, I was thinking, even if some algorithms follow a time clock, then the others who react to them, to the time clock followers, they're going to look like they also follow the time clock. Is there a way for you guys to say anything about that? Or is that just something we have to accept?
First, I would say this is certainly the case, and I would expect that some of that patterns that we observe also among the other categories could be partially explained by this fact. But I think especially for those spikes that are not happening at the beginning of a minute, but at these 10-second intervals, it's pretty apparent this is one kind of order and not the other types of orders or types of collocation and capacity. Yeah, it's hard to directly measure what's a response to someone else. Of course, you could take any pair of participants and see who's trading ahead of whom. Though, yeah, I suppose you would find something that is consistent with what you suggest. But I guess that would be maybe a bit overkill to have hundreds of participants and pair them against another and try to see who responds to whom.
Mm-hmm. Josh.
Hi, yeah, thanks for the interesting talk. I just wanted to ask about those graphs you were showing at the end, that show kind of this relationship between periodicity and collocation,
Mm-hmm.
right? So I know you said you didn't want to push a causal interpretation there, but I was just wondering, what could a mechanism underlying a causal interpretation possibly be, right? It sort of seems to me that, if I want to trade in a periodic way, or if I want to avoid that and just kind of trade randomly, I can do that regardless of whether I'm collocated or not. So how could that be causal?
So the periodicity as such, I think that it can be obviously causal because if you observe the market only every 10 seconds or every minute, you're gonna miss chances of getting good executions. And so if you mechanically submit orders to the market, regardless of the state of the order book, I would assume you definitely get worse aggregate execution than otherwise. Yeah, if you use collocation while doing that compared to using collocation while actively observing the market, I think there you would expect the main difference. You wouldn't expect large differences between using collocation with periodicity and not using collocation with periodicity.
Okay, thank you.
Christian, so PK followed up on his earlier question.
Mm-hmm.
If you'd like to take a look in the chat.
We know they are definitely much less likely to be cancelled. So that's what we can see from the order to trade ratio. Whether that is an explanation for the outcomes in the end, we cannot say because we have no way to create a kind of exogenous variation in this behavior. But we think that's certainly an economic driver of this, but we cannot be too strong in directly linking this to the outcomes.
Right, but if you can differentiate the OTRs for custom versus proprietary. I think that what you just said, I kind of answered my question. So yeah, thank you.
Marius?
Yeah, I was wondering, what's the cost for the broker to just feed that customer order through the same algo that it has? Is it, because the colocation cost is already sunk, is it fine-tuning the parameters? That's the problem here. That's the moral hazard issue, or
I think the main reason is that, the main reason, if you assume that that they don't get the same algo, so the difference, or the reason for not giving the same algos would be that there's a bandwidth constraint on the Colo server. So the largest participants have multiple servers sitting there, and probably for a reason. And so you don't want to limit the bandwidth you need for your proprietary orders if you can avoid it.
okay? So
I'm not saying that this is a reason. We can observe this, of course, but that would be a reasonable economic motivation for that.
okay, so they're basically different avenues. One is it's an opportunity cost. If I want to use the server for my prop orders, then I cannot just send the customer.
Yeah, I mean, they may use the same server, but they just may not actively monitor the market for that. So, I mean, if they look every second at the order book and revise orders, that doesn't cost capacity. But if they were continuously monitoring the market for themselves and for customers across hundreds of different stocks, there you probably reach the bandwidth constraints.
Okay. Thanks.
All right. Any more remaining questions for Christian? If there are no questions, Christian, I'd like to thank you very much again, both Christian and Stefan, for coming and sharing your very interesting results with us. Just a quick reminder, we are off for the summer, and we will be back in September at some point. There is a call for papers on our webpage. Please submit your new work, and we'll be happy to showcase it at the Microstructure Exchange later this year. And I hope that everybody has a great summer, or if you are on the other side of the world, then great winter. And see you in September.